The Nasdaq 100 gapped overnight on Sunday on news that lawmakers passed a short-term bill to avert a government shutdown. This short-term bill only kicks the can down the road, hence why treasuries continue to sell off, with the 10-year yield edging higher on Monday. Comments from Fed Vice Chair of Supervision Michael Barr didn't help, as he said that he sees rates higher for an extended period of time to bring inflation back down. This saw the Nasdaq give back gains and fill that gap on Monday, as shown in the daily chart. Price tagged the 20-day as resistance before finishing the day unchanged. Tuesday we had another retest of the 20-day as resistance before a sharp sell-off triggered by job openings, which unexpectedly jumped in August, coming in at 9.6 million when analysts had expected 8.8 million. The stronger than expected labor report puts pressure on the Fed to raise rates further, hence yields reacting and stocks selling off. After all, if you can nearly earn 5% on a risk-free 10-year treasury, there is little incentive for traders to look elsewhere, which is why stocks get hit. The 10 and 30-year treasury yields continue to hit levels not seen since 2007, and that is really rattling traders. It's not just the US, however. Yields are rising globally, as shown by this chart, comparing the 10-year in Germany and Japan. This chart shows rates are back to their historical average after being at 5,000-year lows over the last decade, according to Bank of America. One chart that has been doing the rounds is this one, which shows China has been heavy sellers of US treasuries, with nearly 500 billion worth of treasuries sold in the last decade. This could be a major factor why yields continue to rise. China could be selling because their own economy is weak, or it could be a potential shift away from dollars. Back to the daily chart, and Wednesday saw price hit a low that coincided with the previous Wednesday low around 14,440, putting in a double bottom for now as price bounces. The bounce was triggered by yields pulling back after monthly private payrolls report came in much lower than expected at 89k when 160k was expected. This chart of the 10-year versus the Nasdaq 100 highlights the turning point of when the report was released, showing how yields came off and the Nasdaq 100 rallied. Thursday price remained subdued, with Fed's daily talking down prospects of any further rate hike, keeping the selling capped, after she said the rise in bond yields recently builds a case for a Fed to hold, as the market is already pricing in higher rates. Today we had the jobs report, which came in above analyst estimates at 336k, when only 170k was expected, but average hourly earnings missed. The knee-jerk reaction was a spike in yields, which saw stocks fall, but that changed after 15-20 minutes, with yields coming off, which is supporting stocks. What is interesting, if we flip to the weekly chart, for all the negative sentiment around yields and borrowing costs, the weekly trend line has held for a second consecutive week on the Nasdaq 100. That suggests we could be due a bounce, as the selling remains capped unless the weekly trend line is broken to the downside, which sits around 14,490. On the daily, the key technical moving averages remain the immediate hurdle for any potential rally, the 20-day at 14,860 and the 40-day around 15k. If we did breach above these, that would pave the way for 15,500. Whilst I don't expect this week's low at 14,430 to be the low, the lack of conviction to break the weekly trend suggests we could see a short-term rally, especially with earnings kicking off next week. Big banks are up first, with JP Morgan reporting next Friday, and we have the latest batch of inflation reports with producer prices on Wednesday and CPI on Thursday, so that'll be the focus. With that said, thanks for watching. Remember to hit that subscribe button so you don't miss out on future content, and I'll see you at the next one.